noon to 1 o'clock in the afternoon, New York time, that is a no trade time period. I don't care who tells you that they can do this and do that. If you're learning from me, just don't trade during that time, okay? Not even in demo, because just trust me, don't do it, okay? As we go through the mentorship, you'll understand more reasons why I just can't give everything in one video, obviously. I want to, and I want to do 4-hour-long teachings, but I'm trying to make them palatable because I know majority of you don't have the attention span because you're new and you're just now discovering. So I'm trying to bear that in mind when I'm making these presentations. So you have your daily range on an intraday basis all set up and laid out. So these are your boundaries. Your morning trade is between 8:30 in the morning. Why? Because there's news events that come out at 8:30 all the way to noon, preferably around 11 o'clock. I generally don't like to take trades after 11 o'clock in the morning. Now, it doesn't mean I haven't or that I won't. I just generally try not to. I want to try to be positioned before 11 o'clock and hopefully be riding something into the New York lunch at noon. And then, squaring positions or taking some off if I'm going to hold through the lunch and anticipate something going through to the close. And we'll talk about that when we get into profiles. Not volume profile, okay? The idea of the afternoon session, I wasn't going to teach that, but because I see a lot of nonsense on YouTube, I'm just going to teach it to you. Okay, so it's going to be a complete daily treatise on the entire daily range of indices. So that way, if your interest is in this asset class, you'll have a far better chance of being successful, in my opinion, using the information I'm going to give you. Okay, and I'm proving it with actual executions, as you'll see later in the video. All right, so we're looking at prior to 8:30. What are you looking for? Okay, I got a lot of questions in the comment section. I'm reading all the comments, folks. I love it because it's real short little snippets. I know a lot of my students, they like to send me these really long-winded, appreciative emails, and then they give me one chart that doesn't really explain much to me, and I can't really answer it. So the comment section that I'm opening up on every one of these videos, if you haven't noticed, I'm allowing one comment that to kind of like honor those individuals that are showing appreciation and are not gratuitously looking to praise me. I don't like that, okay? I like the appreciation for my time and energy and sacrifice, giving it to you for free, but I don't want to be worshipped, okay? I don't want all that kind of stuff. Don't call me the GOAT. Don't call me the greatest of all time. I don't like that kind of stuff. But if you have something that you want me to touch on and improve a delivery or explanation of a specific thing I mentioned in a video, I may already have something in a future lesson planned, but if it's something that I don't have in my outline that's going to be in future videos, I'll utilize the feedback I get. Okay, so that way, I understand some of you want everything all at one time, and there's no way I can do all of that in one time. But I am taking the feedback I'm getting from you all, and I'm using that, okay? But one of the questions I got was, what highs and lows are we looking for that, a stop run would be framed on, or what would be the catalyst for a stop hunt? Well, prior to 8:30, if you look at that, okay, we'll just grab a horizontal ray, and we see this high here, and I'm utilizing this with the benefit of hindsight because this is how you're going to go back and back test everything. I want you to take a look at the high here, and the low right here. So prior to 8:30, in other words, to the left of that, on a 15-minute time frame, what's the most significant or obvious swing high and swing low? Swing high is this. It's a candle with a lower high to the left of it and a lower high to the right of it. 3-candle pattern, okay? It does not matter if the candles are up or down closes. You're just looking for a swing high, because above that's going to be buy side liquidity or buy stops, and a swing low prior to 8:30. That's a candle that has a higher low to the left and a higher low to the right of it. It's 3 candles. Again, it does not matter what the close of the candles are. It has absolutely no bearing on what I'm showing you here, because the swing points are where liquidity is going to be placed. Okay, so once you have these levels on your chart on a 15-minute time frame, then you can drop down into your first lower time frame for entry. That's your 5-minute chart. So let's do that now. All these things will be transposed right to the 5-minute chart. You won't lose anything, in case you're wondering. I know a lot of new people are afraid if they do something with the time frame, they'll lose their annotations. All right, so now we have this old high back here. Look at this price right there. Okay, that's going to be the high price on that particular candle right there. It's 45.14.5. This candle trades to 45.14.5. Exactly the same high. When we have that, but look closer, we have relative equal high, but we have it in multiple short-term highs that keep going higher. If there's 3 highs that go up like that, that's a classic 3 drives pattern. There's a book I really enjoyed when I was in the 90s, Linda Raschke and Larry Connor's Street Smarts book. Really nice little book. I don't like everything in the book, but I liked a few of the things that they talked about. And it helped me understand stop hunts, because I couldn't understand it as a developing student. That why would the price want to go for those stops? It didn't make any sense, because the books that I had bought never really explained all that in detail. They just said, trust this pattern of continuation or reversal pattern. And the idea of stop hunts or raids on liquidity never really came up. So it was an alien topic to me. So when I started delving into the charts and started looking at it, it helped me. And the pattern that she and Larry mentioned in there was the 3 little Indians pattern. It sounds quirky, sounds a little silly, but it's basically the 3 drives pattern. Okay, that means it's a swing high, a higher swing high, and a higher swing high. So it's 3 times the market kept pressing up. I like to see this pattern forming when there's an old high back here. Okay, on any time frame, it's universal. Okay, but if you ever start seeing these 3 drives up into an old high, you don't have to see that 3rd high take out the old high, because what it's doing is it's already pressing into running out liquidity. Every time it creates a swing high and it starts to go down, bears are trying to sell that, and they're putting buy stops right above the previous high, and they keep getting taken. So it's already building in liquidity. And informed investors, or quote unquote smart money, will be already establishing short positions. Then the market breaks. In one of the previous videos, I talked about the pattern or the setup, and I suggested not using a particular swing low that looks like it's been violated. And why didn't that trade work out? Wouldn't that be a losing trade? I want you to think about this idea that I teach, which is displacement. Okay, if you have a children's swimming pool, okay, if you have a children's swimming pool in your backyard and you fill it up, and then you have an elephant just fall down inside of it, what's going to happen? The water's going to be displaced. Okay, it's going to be an obvious displacement of that water. Rather simplistic analogy, but that's what you're looking for in price. When price goes above an old high and it trades down below it, you want to see an obvious displacement. You don't want to see it just do like, oh, well, you know, a little lethargic run here. That's not enough. This is like that elephant falling into that children's swimming pool. It's no doubt about it. It really had a displacement. When that occurs, then you go in and you start looking for the fair value gap, the low, the high, and if it trades back up into that, then you can look for a short. Okay. There's a process that you go through learning it, and it's good that 3 of you were very critical about it, but trust me, there's rules for a reason, and I'm not trying to hide failure, because these patterns sometimes will fail you. Okay, you'll read them wrong, or they just won't work. Okay, sometimes the market will have some kind of a news event that comes out, or it just simply just rolls over top of it and goes higher or goes lower. That's a losing trade. That's why you have to have a stop loss. That's why you have to have good sound money management, because if you don't have those things, Murphy's Law is going to creep in. And whatever can go wrong will. And if you leave it open to the market's determination how bad the pain's going to be, trust me, you don't want that. Okay, you want to limit that. So now we have this previous high, previous low. Now, if we did not, this is really important that you understand this part here. If we don't start seeing these higher highs forming and it's just one steady run up, then you anticipate a high like this to be taken out. And it doesn't need to be taken out by much. Just trade above it. And then you want to look for this energetic movement lower. That's displacement, where it's really animated. So in other words, it would look like when you're looking at your chart. That's a little bit more pronounced because it went above this previous high here. You're looking at this one, but as it's starting to move towards that old high, remember 830, prior to that, you're looking for, what's this? It done a swing high? Yes. So it's trading above it here. Does it have an energetic break below that? No, it's just a very weak, anemic move lower. Then you have another run higher here. And then you have this wick or tail come down, and it quickly snaps back. Does that create a fair value gap in that? No, it's not there yet. Then it goes higher here. Doesn't go above, it matches that high. But then now this high, watch, does it go below that? Yes, a little bit here, but it's a little anemic still. But then look what we have here. It trades up and then smashes down. Then the next candle here closes. What do we have? There's your fair value gap. That's your short. And you could reach for the liquidity resting below that low that you would be identifying prior to 830. So sell side liquidity matching up with your short. You sell, you want to buy it back to cover that short. Well, here's waiting sellers right down here in the form of sell stops. Bam, hits it. Okay. Putting aside that you may not have seen this as a long entry. Okay, maybe you didn't see this as a potential continuation of bullishness. But look at these highs here. What's resting above that now? Buy stops, buy side liquidity. And then what do we have here right before lunch hour? It goes slightly above it and then trades down. And then we're in that time of the day, you don't trade it. New York lunch hour, noon to 1, don't trade it. Okay, do not trade it. It can do a lot of weird things in that hour, or simply do nothing and go sideways. But either way, you don't want to be a participant in that because it's not usually a clean time of day for price action. So now here we have the high of the day and all the liquidity resting above here that would not have been tagged by this. In other words, stops that are resting a little bit above that. Because there's a lot of people trying to sell short. They want to see this thing go lower. But we created a very important low last week, and the market has already tanked a lot. So it's pulling back up in the run that it created going lower on a daily chart. So all these buy-side liquidity pools here are going to be a reason for the market to want to reach up to that. Because you don't have to be a participant down here as a buyer. You just need to know on the other side of lunch at 1 o'clock, start watching and see, is there an indication that this thing wants to go higher? And as you can see, all the buy side liquidity here ran aggressively here, but then the market trades right into the close, aggressively bullish. Small little retracement here, small little retracement here, and then immediate run right into the close. Now, obviously, the market trades a little bit beyond that, but this time of day, expect whatever algorithms that you would expect to be driving price and price runs to pretty much cap the majority of the volume that's going to be in that day. So what I want you to think about is how the day's designed to have a morning move, a lunch hour where you don't want to be trading, and then the afternoon move. Go back through your charts, and you can go back as far as you want. The more you do this, the better you'll get. But I want you to think about creating your charts like this and then describing what the morning trend was. Was it a bullish move? Was it a bearish move? Was it consolidation? If it was consolidation, prior to that part of the day, in other words, the previous day or the previous days, was it bullish or bearish then? Because if it was bullish, this is probably setting up another continuation higher, especially if you start seeing these relative equal highs forming, where it paints the idea that this is retail resistance. So traders are going to think that this is going to go lower. And that starts to build up a lot more interest in the form of buy-side liquidity, or buying interest at a high price. Even though that those traders may be framing the context of their trades as a short entry, trying to make money going lower, their protective stop, if they choose to use one, it's going to be in the form of a buy stop. And this is where it's going to be at. So the market's going to want to gravitate towards that, especially if you start seeing the swing lows, not the one in lunchtime, ignore that one. You start seeing the swing lows that are forming. Every candle that has a higher low to the left and higher low to the right, if they start building up and every time they create a new one, it's going higher, that's a underpinning of the marketplace that's showing accumulation. It wants to go up because it wants to clean out all this here.